Welcome back to my channel, Balance Sheets Matter. Today we're going to be looking at Starbucks and do a stock analysis on Starbucks. But before we get into the video, make sure to subscribe to my channel, Balance Sheets Matter. I do individual stock analysis videos, so if you want to get a good ideas of potential stocks to buy, value traps to avoid, or just want to get better insights about individual financials of different companies, make sure to subscribe to the channel. And if you do want me to do an individual stock analysis, make sure to leave it in the comments below, because I do frequently get the subscriber requests and suggestions for companies to look at. And with that, let's get into the stock analysis. So let's look at a few of these just top level metrics on the Guru Focus page here, basically to get an idea of where the company's sitting at. We can see right now they have a PE of 23.22 and a forward PE of 21.4. So that is basically saying they are going to be getting, at least by analyst estimates, a little bit of EPS growth going into the future, although it isn't huge. We can see on the Guru Focus value band here, it is looking like they could be a little bit undervalued according to kind of their previous basically metrics. So we're going to have to see how accurate that is. And also for those dividend investors, they have a 2.53% dividend with a pretty reasonable 0.58% payout ratio. And they also do grow their dividend quite nicely at an average rate of 8.9% for the last 3 years. And as you can see, they also have been buying back shares, returning capital to shareholders through buybacks and basically dividends. So let's dive into the financials here a little bit more. You can see basically the growth rate per share has grown at 12% revenue over the last 10 years. And you can see on the right here in the green line is the analyst estimates. And they are expecting to, or at least estimating, that Starbucks is going to keep growing at that rate. The EPS growth has been a little bit lower, but we're going to get into why that possibly could be as we dive into the financials. So first thing, looking on the income statement here, you can see overall, basically, other than 2008, 2009, the great financial recession there was a decrease in revenue, which is one of the reasons the stock dropped so much. But apart from that, it has been consistently growing every year, other than in 2020, which we all know why there was a little decrease there. So that's kind of a one-time write-off. But the overall trend still has been up at that very consistent rate. The next thing I like to look at is the gross margins. This kind of gives you an idea of the company's competitive moat, if it's basically they're increasing it and their gross margins are increasing, or if they're losing it and they're decreasing, which would be a bad sign. So we can see overall, basically ignoring however they were doing their counting before 2011, but from 2011, started about 27, they crept it up to about 30, 31, and it's decreased a little bit, of course, ignoring the 2020 year, because that's a little bit of a one-off, and it's kind of back around that 27 to 28%. So I really wouldn't consider this concerning right now, even though it has decreased from kind of 31 to 28, maybe 28, that 27, 28 is just going to be their more consistent forward going gross margin. But if this were to slip in the future, this is something I kind of would start getting concerned about. If they start dropping to 26 or 25, then that's when I would basically start worrying with Starbucks that there may be a few warning signs there. Next, we can basically see the operating margin has pretty much operated in line with that. When they did have the little bit higher gross margins, they had a little bit higher operating margins. And other than that, it's sitting at right now 15.62, which is pretty good. And that's important, especially for basically a store like Starbucks, which has a lot of individual locations with different employees, because you can kind of tell if they're increasing their efficiencies or losing their efficiencies. And basically the selling and general admin, because for every store, there's a fixed amount of basically employees you kind of need to some degree, although there is going to be potentially some more automation taking over in the future. But basically they have kept these selling and general admin expenses in line with their revenue growth. So that's a really good sign that overall the gross margin seems to be maintaining. The operating margin seems to be maintaining as well. So the next thing to look at, basically see what their interest expense is looking at. So they do have a little bit of interest income coming in, which is very nice. But the interest expense, you can see, has been creeping up over the years quite a bit. And we're going to get a little bit into that later, and it does relate to buybacks basically. But right now they're sitting at about $560 million of interest expense, net interest expense $457 million. And in comparison to their operating income of $5.3 billion is very healthy. I usually like to look at a 1 to 10 ratio for that, in my opinion, a really healthy interest income to operating basically income there. So they're still sitting at that right there, but we're going to actually see if if this decreases, it would start changing my perspective more in the future. And you can basically see then net income, it's been increasing up as well. And other than sometimes you get these one-off years from the other expenses like our income, so you kind of have to This is why I look at so many of these top level metrics here to kind of get an idea of where things at, because these other expenses and other incomes basically can throw off your EPS quite wildly, even though they're not real cash expenses. They're just sometimes, writing off a bad acquisition or something else, and it kind of throw things off, and you get a little bit of off years. But overall, you can see basically net margin sitting at about 11%. This does seem kind of like fairly consistent around the 10% or just above, although, it has been higher in the future. And a lot of these years, there has been some other incomes. And the next thing is basically the shares outstanding. They have been returning capital to shareholders. Although you can see basically kind of from 2010 to 2015, they really didn't do any share buybacks in this point. And then after that stage, they really started buying back a lot of shares really heavily in 2018. As we're going to get into a little bit later, you can see they really started decreasing their share count down as well. So let's get into the balance sheet, because balance sheets matter. And right now they're sitting at about just 6.6 billion, we'll call it, of total current assets. Just cash equivalents. A lot of it, like Starbucks, they have their gift cards. So there's a lot of money that's locked up basically in Starbucks gift cards, actually, which is kind of just something you're going to see in a few places on the liabilities there. So, they got 6.6 billion in total assets, but in total current liabilities, they do have about 9.4 billion. And I was starting to mention the gift cards because they have other current, basically deferred revenue, which I'm pretty sure on the short-term liabilities is relating to their gift cards. They basically already do, because they've already taken the cash in for that, but they're going to have to give out product when customers redeem those gift cards. So that is initially looking like not the best current ratio for a big company like Starbucks. It's not too big of an issue. And also, we do have to factor in that 2.2 billion of this really isn't stuff they have to pay out, but just products they're going to have to give the customers. So overall, pretty tight balance sheet for that of, not too good, not too bad, but, they're going to be able to maintain it. You can see basically the total current liabilities sitting at $37 billion here. We do have, where do we have any goodwill? Well, that'll be the assets. So we have $37 billion of basically total liabilities and only $29 billion of total assets, with $3.3 billion of goodwill. So we're going to have to take this off because it isn't really real. And you might have already seen down here that leaves us with a lot of negative equity. And this kind of gets into the one thing I don't like about Starbucks, and may kind of lead to them maybe garnering a smaller multiple than they have in the past going forward into the future, because they're basically sitting at $8.6 billion of negative equity because they have a lot more liabilities than assets. And also, if we factor in that goodwill, we're sitting, I think it's like closer to $12 billion. And in relation to the market cap, which they're just under $100 billion, that's a pretty big chunk of their market cap. So this, I think, just really has to be factored in the valuation multiple you get, because when you look back here, they had positive equity, and this affects the stock a lot, because basically, as I was saying, they've done a lot of share buybacks from 2018 going forward. And now you see a little bit why that is their total equity has gone negative, meaning they basically, as we go on to the long-term liabilities here, you can see they've really started basically in 2018 taking a lot of debt, and we can obviously see it has been used for share buybacks, and they've been taking a lot of debt there. But if you actually look at the interest rate they're paying on their debt, just to kind of bring this into another perspective, they're sitting at 13.565 billion in long-term liabilities, and then 1.45 in short-term liabilities. Just call that, $15 billion, but they're only paying $560 million in interest expense. So that's only a 3.7% interest rate. And you can kind of see that as we're going to go, which I don't always do, but go into actually look at their bonds. And Starbucks has a lot of them. Some of them are a little bit shorter. A lot of them are long-term out, but Starbucks has a very low cost of capital. When they issue bonds, they get them for very good prices. As you can see here, this is 2023 bonds at 3%. And if you go through these other ones, you'll see there's some 2%, 3%, 4%, 5%, 3.5, 3.5. They have a lot of debt issued at some pretty favorable rates. Unfortunately, a little bit of some of this debt for in the shorter 2026 is expiring soon, but they still do have some debt that's pretty far out. Even 3.35% for 2050, that's really, really far out, and kind of does really speak to the quality of company Starbucks is, that they are able to get this type of debt at these extremely low rates so easily. So Let's go back to the financial statement here. But the one thing to keep in mind of that, if they basically do have to renew the debt at higher interest rates, they may not want to do that, and they may end up actually stopping share buybacks more to basically pay off that debt rather than issue it at higher interest rates, because it would mean they're paying out like a higher interest rate and more interest expense, which wouldn't be too good. But that's going to be a decision by management. But I would prefer them to kind of pay down the debt if they can't refinance at good rates. But we're going to go into the cash flow statement now. You can see overall cash flow from operations has been very positive. They do have a little bit of stock-based compensation, but in the scheme of how much basically everything is, it's very little. Important to look kind of where at the cash flow from depreciation is and compare it to the cash flow from operations. And considering Starbucks is still a growing company, we would expect the purchase of plant, property, and equipment to be higher. So this is fairly expected. That's a little bit higher. And some years it's even quite flat. So this is kind of showing that at least assets we are seeing on the balance sheet, not that there's a huge amount of them because of all their negative equity, they are fairly like real and they're not having to replace stuff that hasn't been effectively depreciated yet, or vice versa. So let's go down a little bit more and you can basically see where this money's been going. And we can see that there's this little bit of stock issuance. There's much more bigger purchase and repurchase of stock. And like I was saying, 2018 is when they really started buying back shares and they started basically going into the negative equity. And you can see $7 billion of buyback in 2018, then 10 billion, then 1.7 in 2020 because they kind of had to stop. In 2021, they didn't. And now they've kind of started creeping back into those buybacks a little bit. Definitely not at the rate before, but you kind of also have to realize because they took on debt to do a lot of this, which you can actually see a couple lines down further on the cash flow statement, we can see net issuance of that basically really in 2018, they really started issuing a lot more debt, and that's really helped their share buybacks in the short term. But you can only do that once, or probably at this point not going to continue to be taking on a lot of debt to buy back shares, so that will slow the EPS growth a little bit. So we can't expect basically the share buybacks to continue like they have in past years for that reason. But regardless even of that, the cash flow has been very positive. They are able to buy back the shares, and the dividends here are easily paid by the cash flow. And the last year here, how much was it? We were at about $2.5 billion in dividends and $4.3 billion in cash flow. And you can see that wouldn't leave very much for share buybacks. So I guess what I'm saying is probably expect lower share buybacks from Starbucks in the future compared to the pre-2020 years. That's not a good comparison. So let's get into the interactive chart now, trying to get a relative analysis going. Let's just first pop up the revenue with estimates and the EPS to estimates to see what analysts are thinking. You can basically see they're expecting pretty much it to grow at the expected rate of the revenue, which I think is a little bit over 10%. And this is, very, very good growth here. When you're going from $4.10 to $4.84, that isn't that like nice mid-teens level. And that's, I think, kind of the little bit revenue is a little bit lower, so maybe there's factoring a few share buybacks in there, but overall they are going to be expecting some decent basically EPS and revenue growth going forward. So that is the base case right now. You can also see basically the price to sales ratio, relatively speaking, other than comparing to 2008 2009, it is looking pretty cheap, and its comparison basically a low here, a low there, a low there, a low there. Other than 2008, 2009, if you actually look back at all this history, this is one of the cheapest levels they've been at. And we need to compare that to the net margin. So let's bring that up. And you can see the net margin actually has been rising. So this is one factor that does lean to Starbucks being a really deep value, but we also have to factor in that they do have a lot of negative equity, which you kind of do have to factor into that price, which may mean a lower multiple, like say, I would say 10% would be a pretty fair thing to do. So, just to kind of ballpark add this in, maybe say this 2.72 in comparison to maybe past years like this is maybe a little bit more like a 3. So it's still, I would say, cheap, but it just does mean it can be lower because of that big negative equity they have. And then we kind of look at the same thing with dividends here. It's going a little bit shorter trend, but dividends sitting at 2.53. This has been a previous high for it, although because of the weakening balance sheet, basically 2020 going forward, I would say that does lean that they could potentially get lower, although I do think they are actually, a fairly reasonable value right now. Now bumping into the stock chart here, you can see just a little bit of the long-term trend here and kind of this trend they've been on here. And it is starting to weaken a little bit. And this is kind of why I just put this line down here, is this is a level I would realistically see Starbucks getting into. I've got a very small starter position already right about here before this drop, and I'm just kind of waiting to see where this is going before I start buying a little bit more and maybe making this more into a substantive position, because Starbucks is, if we go back to the interactive chart here, I actually want to show you the P ratio and kind of ignore this really big spike here. They're sitting at a 23, and just watch right here where you're going to see it, because it's kind of hard to see exactly on the line. But you can see mostly a lot of the history, they've traded actually at the low side, low 20s, but then on the higher side has kind of been more in those 30s, even mid 30 basically levels for the P ratio. So we can actually also look at that if we go at price with P with estimate, and we change this to 30. Let's put that there. And let's take off the PE. This is one thing I like about Groove Focus, is you can chart these metrics and projections. So if they were to return on a 30P ratio, this would be kind of the expected trend in the future. But I would think, just because of the weaker balance sheet compared to the past, I would at least lower that by 10%, maybe give them a 27, seems more reasonable. Not saying they can't get to a 30, but a 27, maybe even a little bit lower, would just be a more realistic number after factoring in the balance sheet. And you can see that lowers it a little bit, and it does change the story. So it still looks like it could be a good value. I'm just saying it could drop a little bit more. It is definitely a stock I have been interested in, and I have basically got my smallest starter position, and I do plan to increase it. And if it does basically start getting more to 80, and as you can see now we're on the monthly chart, this red 100-month moving average, and getting into that 100-month moving average, I probably would increase it to a normal size position. Not a large position, but a normal size position at least. So anyways, that's my stock analysis on Starbucks. Those are my thoughts on it, what I'm kind of like, personally doing with it. I hope it's gave you a few insights into basically where the company's sitting at in their financial state. And of course, make sure to subscribe to the channel, like the video, and I'll see you in the next stock analysis.